Welcome back to our ongoing series on the economy. Today we're delving into a pressing question that's on everyone's mind. What is causing the recession in the economy? As we navigate through a sea of economic data, policy changes, and global developments, understanding the root causes of the current economic slowdown is crucial. Let's start with the stock markets, which have been experiencing significant volatility lately. The tech-heavy Nasdaq and the broader S&P 500 have both seen substantial drops from their recent peaks. This shift has been sudden, leaving many investors and analysts scrambling to adjust their expectations. Just a month ago, the markets were at record highs, buoyed by optimism about tax cuts and deregulation under President Donald Trump's administration. However, the landscape has changed dramatically, with tariffs and trade tensions taking center stage. One of the primary drivers of this economic uncertainty is the aggressive implementation of tariffs by the Trump administration. These tariffs, which have been imposed on major trading partners like Canada, Mexico, and China, are designed to protect domestic industries, but have sparked fears of a trade war. The tariffs on steel and aluminum, for example, have been doubled for imports from Canada, a move that has led to retaliatory measures from other nations. Tariffs can have far-reaching effects on the economy. By raising prices for consumers, they can reduce spending, which is a significant component of economic growth. Businesses facing higher costs due to tariffs may also hesitate to invest in new projects or hire additional workers. The uncertainty surrounding trade policies can further exacerbate this cautious approach, leading to a slowdown in economic activity. According to economists, while the immediate risk of a recession might appear small, the prolonged impact of these tariffs could increase the likelihood of an economic downturn. Goldman Sachs, for instance, has estimated the odds of a recession at 20%, while Harvard economist Larry Summers has suggested a 50-50 chance, pointing to the chilling effect of tariffs on demand and rising prices. Another factor contributing to the current economic situation is the Federal Reserve's response to these developments. The Fed, which has been monitoring inflation and employment closely, faces a delicate balancing act. On one hand, tariffs could drive up inflation, prompting the Fed to consider raising interest rates to keep price increases in check. On the other hand, if economic growth slows, there may be pressure to lower rates to stimulate activity. This dual challenge complicates the Fed's decision-making process. The uncertainty surrounding tariffs and their potential impact on inflation and growth has left the Fed in a wait-and-see mode. As Federal Reserve Chair Jerome Powell noted, the central bank is navigating a complex environment with potential negative effects from tariffs and extraordinary uncertainty. Furthermore, the broader global context cannot be ignored. The interconnectedness of the global economy means that trade tensions and tariffs can have ripple effects across borders. Retaliatory tariffs from other countries can make U.S. goods less competitive, affecting exports and potentially leading to job losses in export-dependent industries. The labor market, while still showing signs of strength, is not immune to these pressures. A rise in unemployment or a slowdown in job creation could signal deeper economic issues. While recent data shows that employers are still adding jobs, the uptick in the unemployment rate and the potential for widespread layoffs, particularly in the government sector, are causes for concern. Consumer behavior is also playing a role in the current economic landscape. Recent data indicates a decline in consumer spending, even as incomes have risen. This could be a sign that consumers are becoming more cautious amid the economic uncertainty, choosing to save rather than spend. Such behavior can dampen economic growth, as consumer spending is a significant driver of the economy. Businesses are feeling the pinch as well. The uncertainty over tariffs has led some companies to delay or cancel investments and consider price increases to offset higher costs. This cautious approach can hinder innovation and expansion, further contributing to the economic slowdown. In addition to these factors, the psychological impact of economic uncertainty cannot be underestimated. Market volatility, conflicting policy signals, and concerns about future economic conditions can erode consumer and business confidence. This erosion can lead to a self-fulfilling cycle of reduced spending and investment, further slowing down the economy. As we examine these various elements, it's clear that the current economic situation is the result of a complex interplay of domestic policies, global trade dynamics, and consumer and business sentiment. While the immediate threat of a recession may not be imminent, The risks are elevated, and the path forward remains uncertain. The key takeaway is that navigating this economic environment requires a careful and informed approach. Policymakers, businesses, and consumers alike must remain vigilant and adaptable, prepared to respond to changes in the economic landscape. As we continue to monitor these developments, we'll keep you updated with the latest insights and analysis. Thank you for joining us today, and we look forward to bringing you more in-depth coverage in our next episode. Stay tuned and stay informed.